Welcome to Freed on Business. He grew up in South Florida, has been in business here since the early 90s, and has closed over $3 billion in deals. He's seen it all. He always has an opinion, and he's always ready to share it. Informed, entertaining, and connected, he has his finger on the pulse of South Florida's business community. He's Jim Freed, and this is Freed on Business.
Hey everybody, welcome to a great, fabulous edition today of Freed on Business. It's going to be a very positive energy day. We're going to talk about the general state of the capital markets, and we're going to give as much positive energy as we possibly can to the situation. I just got off the phone with a couple of different investment sales brokers here in South Florida, and they say that they see things picking up. One was in office, one was in retail. We'll get back to that and what they say is happening in the marketplace. In just a couple minutes. Of course, I want to start the show by thanking our sponsors for well over a decade, Warren Henry Automotive. When you're looking to lease or buy a car, you want to get every advantage that you can. That's why you go to Warren Henry Automotive. My wife and my mom both just got new cars from them. Vivian got an Infiniti. My mom got a Lincoln. They sell both those brands as well as Land Rover, Range Rover, and Jaguar up at 151st and Biscayne. And Gainesville, they sell Audis. South Dade and Weston, they have great Western Broward, they have great Land Rover, Range Rover stores. And of course, down in the Keys, they sell all their great nameplates. And now on with the show. We're going to talk about capital markets today. I've been calling all over the market in Texas, Oklahoma, Florida, looking for 1031 for one of my clients. We're looking for a $20 to $40 million, maybe $50 million 1031. And while I've been talking to all the brokers, I've been getting their feedback on what the marketplace looks like. And today, we're going to talk about that. In addition, I've also closed a shopping center loan a couple of weeks ago, working for the same family to get another shopping center loan closed. One was a bank loan, one was a life company loan, and we'll talk about what I've learned about with those calls too. But let's start about interest rates. Yesterday on the front page, on the top of the Wall Street Journal, Jamie Dimon was talking about interest rates are going to hit 8%. Today, that sentiment is starting to become pervasive in the marketplace as inflation topped 4% last month. So the hopes and dreams of everybody having an interest rate cut this year, I believe, are pretty much dashed. But if I knew what was going to definitely happen with interest rates, this is my famous line, I would go to Las Vegas. Who needs to be in real estate when you can predict the future like that? The only thing I can really tell you is to lock in your rates now. That's what my clients have been doing. That's what the families I've been working with have been doing on those shopping centers. Time to lock in is now. It doesn't appear that inflation's been tamed. It just appears that it's been jawboned into the corner for a little while. We know here living in South Florida, housing prices continue to rise. So that's a big component of everything. Energy, we'll see what happens with energy. Energy can be controlled by other people. Right before the election, the word is that the Russians may spike energy to hurt Joe Biden. So if prices can be manipulated like that, suffice it to say that the government's going to want to have control, and the way they have control is with interest rates. So I spoke to a couple of different lenders this week, as well as a couple of special servicers looking for transactions. And what I found was kind of interesting. They said, and I'm writing a note here to myself, they said to me that they really haven't seen the REO recognition yet, that they haven't seen the banks have to take the write-downs. They haven't seen the regulators come in and squeeze the banks yet. They expect that to happen later this year, perhaps this summer. Then the banks will tighten credit. They'll start creating issues for their borrowers, perhaps asking them to cure some of the technical defaults they have on their loans. That'll create a problem for the borrowers. They'll have a lot of issues, not just on one property necessarily, but on others. And then you'll start to see the dominoes fall. That's what two different lenders have told me, as well as one of the correspondents for the life companies. So I believe that it's out there. It just hasn't started yet. When I was at the IMN conference a few weeks ago for special assets, that was also the sentiment at the IMN special assets conference. That sentiment was that the REO is not here, that the recognition has not occurred yet, and that the deals will be coming. And of course, the bankers always end that discussion by going, but if you give us some deposits, we'll make sure you're the first person that gets called when we're looking to sell some assets. So the bankers are looking for the deposits because their tier one capital has been impaired. For those of you who don't know what that means tier one capital is the amount of equity that the bank has. They can then leverage a multiple over that. So as their tier one capital declines, which they need to do when they take a reserve for a bad loan, then the amount of loans they can make declines. And now you start to see the cycle that could possibly start to occur. I've been to the movie. I've seen it many, many times before. It hasn't happened yet. Hopefully it doesn't happen again, but the odds are that it could happen. And this could be something that we have to take into consideration. As rates rise, cap rates will follow, even though people say that there's been a disconnect. Eventually the mathematics will have to come into play. And as the cap rates rise, the impact on values will be dramatic. The cap rates, as I said, are a function of the interest rates and the return that you need. So as the interest rates rise, cap rates will have to rise with them. And as cap rates rise, we all know that values decline. As people thought value would stabilize or decline after the early part of the year when they thought inflation was tame, people thought, well, there's stabilization in the market. Now we can predict what values are going to be. But now trades are beginning to happen with these higher cap rates and lower valuations. So people are beginning to mark these values. As the values begin to get marked in the market, the banks will take notice. They'll have to start marking their portfolios down. They'll have to start raising tier one capital or exit the market to some degree. And again, so what's going on the ground? Well, I recently moved back to Edgewater. The people in the elevator are almost all from New York. Most of them have moved in the last 6 months. They're all very happy. Their kids are in school. They're having a wonderful life and they're thrilled. What does that do? Well, that's an inflationary pressure on the marketplace. As they come in, they move everybody through and the prices go up. So that trend, I'm seeing it on the ground, is still occurring. Some people say that it's slowed somewhat, but I don't really believe it. I've met 3 people that moved into the building in the last 2 weeks from New York. So it's still happening. Values are increasing and they're building more condos and more apartments. Will they all be absorbed? I assume so. People keep going, well, when they don't get absorbed, we'll buy them at a discount. No, you won't, at least not at the number you think. I remember the last time that people thought that, and people from overseas are going to pay more than the local US-based people. So as they see that prices go down, the people from offshore will bite before the US-based investors. And I believe that that's what's going to happen here in South Florida, supporting pricing to a level that most people don't anticipate. Question is, where will the locals go? Well, from Miami, will they go to Tampa, Orlando, or Atlanta? I don't know. I just went to the UF Real Estate Conference, and one of the affordable housing developers said he just lost one of his developers to Atlanta. When I talked to my friends in Atlanta, the prices really aren't that much different. So the question is really, where do you go? Cost to build is pretty similar, except for labor in most markets. Cost of land is pretty similar. Cost of money is pretty similar. So where are you going to go to live in a cheaper place? I'm really not sure. Let's talk sector by sector. Retail. Retail is, believe it or not, somewhat the golden child right now. It's taken a real big hit, but at least here in South Florida, we're seeing a lot of retailers expanding. I don't see a lot of vacant retail space, and you really can't find a retail center to buy. Even the best retail centers, good locations, B quality centers, I call that pro forma retail that was just built because the pro forma would allow it and you could finance it. Even those centers are still relatively expensive for the value-oriented investor. I don't really know that you're going to get that much more of a discount in the retail sector. Apartments are going through a dynamic change. There's lots of units, but there's lots of people. I think submarket by submarket is the answer there. But people that built their apartments and then took out variable rate bridge money, they're having a problem. And even if you have long-term money now, the question is, as the interest rates go up, what's the real value of those units? Capital markets are still trying to figure all that out. So there is a slowdown on what can be financed in all sectors. Let's talk about land for a second. Land, what's the value of land? If you can't finance an acquisition of land and you can't finance a building on land, the actual value of the land is probably less than you think it is. When the liquidity for land starts to go, then you've really got a problem, because that will put a hold on development. When the hold on development comes, then you'll see that there'll be a window of opportunity that's created. So the well-capitalized apartment developer is actually in the market right now looking to finance their apartments, and the smart real estate lender is looking at that deal because they're going to deliver in 2 or 3 years. And what's the marketplace going to look like in 2 or 3 years? Well, you got to figure interest rates will settle down. The market will be, if we're in a somewhat recessionary period, it will be over by then. So people are gung-ho on what's going to happen in the next couple of years from now. So that means it got to be in the ground now. Remember, I'm in the market for a 1031 in the $20 to $50 million range. If you have any ideas, reach out and DM me. Now let's talk about single family. Super Lux single family still going strong. You know, got all those glass boxes all over Coconut Grove and Miami Beach. They continue to have good demand. Properties for rent are still extraordinarily strong in the Super Lux sector. And I got a request for $6 million townhouse construction that had 3 units. So that sector is going strong and is well financeable. Condos in different market sectors and segments are still able to be financed. You could still get a pre-dev loan if your deal makes sense, but the pre-dev lenders are very, very cautious. Only if you have real good track record and if they believe that your position in the marketplace is such that you'll get absorption, then you can still get that type of financing. Is it readily available? No. Is it available? Sort of. Can you see it being deployed? Yes, in the Super Lux areas of Miami Beach, Brickell Avenue, Edgewater, and Wynwood, and in some areas of Broward and Palm Beach counties. Industrial, you could still capitalize it. In some markets, it's said to be a little bit overvalued. I saw one beautiful industrial building that's a little bit older, but high ceilings in Tampa that had a $10 million price reduction. That was about 15% off the original ask. So I think that you're starting to see a reality starting to hit in certain submarkets in industrial. Can you still finance industrial? Sure. Can you still get industrial equity for industrial? Sure. Mixed use is out there. It's something that a lot of people are talking about. It's still difficult to capitalize because the lenders look at each component differently. Only an experienced mixed-use developer that has a real good integrated process will be able to get capitalized today, but it's out there, and it's a way that people are beginning to reach for the ability to price the project. If you only have one land use, then it's going to be more difficult. If you have multiple land uses and create a birthday cake, you can probably pay a little bit more for the land. And let's talk about and finish up with hotel. Hotel, you can change the value of the hotel, the income of the hotel on a daily basis as you adjust rates. Here in Miami and South Florida, there's a lot of Airbnb, a lot of home sharing, a lot of daily, nightly rentals. So that may have a significant impact on the luxury market for hotel. But I think hotel in general, well-located business hotels are going to be good. So overall, where are we? Activity's picking up. People are interested. Buyers are looking. Brokers are getting listings. Are all of these deals making sense and coming together? Not yet, but there's activity. Are they green shoots? I hope so. I will tell you that I got a call this week for a receivership, and I called 3 people that took back or having loan problems about receivership. So receivership is out there. It is a place to go. And as far as real estate capital and real estate investing, where is the new capital coming from both debt and equity? Well, we'll talk about that on next week's show with Jim McCarthy. So stick with us. I hope you've enjoyed this round the horn look at the capital markets. Again, the bottom line is be positive, have good energy, make your phone calls. The deals are out there. More activity is out there. The cost of capital is going up. Some people that need to sell are beginning to realize that, and there are transactions that are happening. We've seen them throughout the market, mostly still in the multifamily segment, but mixed use is coming as well. Next week, we'll talk to Jim McCarthy and get you the answers about how we're going to be raising capital in the future. So stay positive. Keep out there. Remember, this is Jim Freed. I'm the founder of Sandstone Realty Advisors. We help family offices and institutions deploy capital and build their business portfolios. Reach out to me, DM me. I'm always here for you. The person who wants to do something finds a way. The other finds an excuse. Now go out there and make it happen. God bless you. God bless America. We'll see everybody here again next week, Wednesday at noon, when we drop our next podcast. And we'll be talking about creative ways to access the capital markets with Jim McCarthy. Mr. Mendoza, the rest of the show is yours.